In this video, we'll go through liquidity pools using stories, examples, and analogies to break down the topic so that even your grandfather can grasp it. At least, that's what we keep telling ourselves. If you're unfamiliar with liquidity pools, you should really be eager to learn more about them. Liquidity pools aren't just made-up pools filled with water. These are money-filled pools. They are, in fact, smart contracts that allow dealers to trade tokens and currencies even when there are no buyers or sellers. Let me begin by explaining how the regular stock market operates. It employs a model known as an order book. This means that all buyers and sellers put down how much of a stock they want to acquire and at what price they want to buy it before submitting their orders. A transaction is made when two buyers and sellers meet at the same price. The seller receives the cash and the buyer receives the stock. An order book, for example, might look like this. When you wish to buy a stock on Robinhood, for example, and at market pricing, you are essentially making an order to acquire all of the stocks you want at the current price at which sellers are ready to sell them for. You can see how many buyers and sellers there are at different prices if you look at the graph on the left. Now you must understand that if you want to purchase or sell, this is inefficient since you must set a price that someone else is prepared to buy or sell at. At the very least, if you need to buy or sell your stock right away. Otherwise, you'll have to wait and hope that the price will finally match what you're searching for. So, what is the solution? It's an algorithm-based liquidity pool. We will always be able to buy or sell an asset with this algorithm, regardless of how high or low the price is, what time of day it is, or if there is a buyer or seller to match our current demands. The liquidity pool is a pool of money that contains both assets of what you're looking to trade for. We'll be using Ethereum and the basic attention token in this example. The liquidity pool is nothing more than a collection of computer programs. It's a smart contract designed to keep certain assets, perform math with those funds, and then allow you to trade based on the results of that arithmetic. Let's go a little more technical now. The pool starts with an exact 50-50 ratio. This means that if you want to give the pool $500 to trade, you'll need to pay it $250 in Ethereum and $250 in basic attention token. Why? In a moment, you'll see what I mean. Most liquidity pools employ a constant product automated market maker algorithm. Because when you buy more and more basic attention tokens with Ethereum, the price you pay for each token would gradually rise. The first one, for example, could cost $20. The next one you buy may be $1.29 and a tenth of a penny. It's possible that the next one you buy will cost you $20 and 3/10 of a penny. After you've purchased 100 basic attention tokens, the price may drop to $50. So that could have been perplexing. Consider it this way. When you acquire more basic attention tokens, the liquidity pool will charge you more and more for each one. This is because it aims to maintain the ideal 50-50 Ethereum basic attention ratio. Token you're buying more basic attention tokens and giving it Ethereum so it thinks the price of Ethereum is falling since there's a lot more of it in the pool. So, in order to maintain the 50-50 value ratio, it will essentially raise the price of the basic attention token, at least using the formula that it now employs. It's important to remember that every transaction in a liquidity pool is subject to a tax. Making a trade will cost you a very little proportion of each deal, and we'll go over where that money goes in a minute. Uniswap is a wonderful example of a liquidity pool. They let you swap practically any Ethereum token for almost any other Ethereum token for a nominal charge. Moving on. One significant and powerful feature of liquidity pools that I'd like to highlight is what if we have a lot of basic attention tokens that we want to exchange for some graph tokens instead of Ethereum. Most decentralized exchanges, on the other hand, will connect to liquidity pools to allow you to execute that trade directly. You might say, for example, that you have a basic attention token and wish to purchase a graph token. That decentralized exchange, on the other hand, will do two trades. The first will convert basic attention token to Ethereum, followed by an Ethereum conversion to the graph token, thus swapping basic attention token for the graph token for you. Routing is the technical term for this, and it's a really powerful tool. Some trade will be routed through the decentralized exchange. For you, so that you can trade any token on their platform for any other token, even if that token doesn't have a lot of liquidity pools. Now that we have a basic understanding of how a liquidity pool works, let's look at why you may want to invest in one. When you do this, you are known as a liquidity provider since you are putting money into a liquidity pool. So, remember how I said that every deal requires a very little fee? As more people trade, though, the costs start to build up. What happens to the fees? They turn to the liquidity providers for assistance. So, let's assume you put $500 in an Ethereum liquidity pool and $500 in a simple attention token liquidity pool. Your friend decides to join you and follows in your footsteps. So the liquidity pool now has a total of $2,000 in it. Now, assuming that people are trading in and out all day, let's suppose you make $150 in fees at the end of the day because you own half of the pool and your friend owns the other half. You gain $75 for providing liquidity. And, certainly, in the present crypto environment, these fees can add up to a lot of money. Because they make a lot of money from the fees, some decentralized exchanges are willing to give up to 500% APR. And, because the technology is still in its infancy, there aren't many investors. However, as more people join the pool, your cut gets smaller and smaller. It does, however, make the pricing more steady. One of the basic principles of how a liquidity pool works is that as the pool's liquidity increases, as more money is invested in it, it takes a lot more money to alter the price of both assets. For example, if someone came to your $2,000 liquidity pool and put in $500 to swap their Ethereum for Basic Attention Token, the price of Basic Attention Token could skyrocket because they literally acquired a ton of it. As a result of the algorithm, there isn't much in the pool right now, but there is a lot of Ethereum. Because of the way the AMM algorithm works, BAT will be more expensive, while Ethereum will be less so. If there was $5 million in that pool of liquidity and someone came along and put in the same $500, the price would scarcely move since they would barely take any of the BAT out and provide any Ethereum, at least in proportion to the size of the pool. Price effect is a term you should be familiar with. And, in essence, how much can I influence the price by purchasing from this liquidity pool? If the pool is tiny, the price impact will be significant. In summary, you will have a significant impact on the price, and in some circumstances, you can easily double or triple the price of an item. However, when the pool increases and becomes larger, the price influence becomes reduced, and large buy-ins have less of an impact on the pricing. Arbitrage traders are another important factor to consider. Remember how I stated that if someone bought a bunch of Basic Attention tokens, Ethereum's price would plummet. At the very least, Ethereum might be $450 per Ethereum in that pool after someone contributed a large amount of Ethereum. So, what if you could get $500 for your Ethereum by selling it to Coinbase? You may acquire a large amount of Ethereum from that pool and then sell it to Coinbase right away. And you'd make $50 for every Ethereum you sold in each transaction. Arbitrage trading is the term for this type of trading. And you could be thinking, why are they going to perform so many trades if all they're going to do is make money? That's precisely what they're doing. They are, however, paying that modest fee and assisting in keeping pool costs comparable to other exchange pricing. They're effectively assisting in maintaining the token's price stability by ensuring that it's the same price everywhere. If it isn't, they can acquire it from a business that sells it for a low price and sell it to a place that pays a higher price. In a nutshell, they'll make money, but we need individuals like them. It's possible that you're one of them. There's one more thing to say regarding liquidity pools' power. They can soon get difficult. Balancer, for example, is a platform that allows up to 8 assets to be combined into a single liquidity pool. The arithmetic and algorithm are insane, but it demonstrates the boundless potential of decentralized finance. Before we wrap up this video, you should be aware that there are hazards associated with investing in liquidity pools. Impermanent loss and rug pools, for example, are two major ones. These are topics for another video, but they're important to remember while investing in these very successful liquidity pools. If you liked this video, please give us a thumbs up and consider subscribing so that you'll be notified anytime we publish a new video about impermanent loss or rug pull, and we guarantee to make it so simple that even your grandpa can understand it. Thank you very much for taking the time to watch. We hope you learned something.